My name is Will Pattison, and I am the head of the Real Estate Research and Strategy Group for MetLife Investment Management. Office is certainly experiencing a large headwind from work from home employees, and companies specifically have almost universally been questioning if this sort of temporary work from home environment they've been in as a result of the pandemic could become longer lasting and if it's sustainable. We're actually not overly concerned with that in the long term, and that's based on an analysis of firms who have tried work from home over the last decade. Almost without exception, there's been about a dozen firms who have made major moves to a work from home environment. Those firms have reversed their decisions after 1 to 2 years, and that's a result of uh, employees essentially becoming strangers to each other, silos building up, and really productivity losses kind of building over time and resulting in the need to move back to office space. In the near term, we are concerned, however, but in the more medium to longer term, after a few years, we think office demand will be relatively strong. The office sector certainly could offer opportunities if the bid-ask spread sort of contracts. Today, sellers really aren't willing to sell at the price that buyers want to buy at least for office properties. So the opportunities today are fairly thin. Going forward, as some sellers need to sell, there could be more opportunities in the office space. But as of right now, and probably for the remainder of 2020, transaction volume is pretty low, and it's challenging to say this is the time to be making an overweight or taking a significant position in the office sector. Yeah, so one trend that has been a headwind to the office sector really for the last 20 years has been densification, or in other words, getting the same number of employees in a smaller amount of space. And that's been occurring for a very long time. We've seen that reverse to some extent during this pandemic. We have within our equity portfolio seen examples of tenants or companies who are leasing more office space so that they can bring everyone back with better social distancing than they could in the past. It's still a little too early to say how much, if any, of that will be permanent. Part of it could have to do with how building wellness scores are calculated in the future. If part of the building wellness score relates to having a pandemic compliant space, then that could be something that becomes more long lasting. Our base view today is that it will really be something that's relatively minor or on the margins, some one-off companies perhaps wanting to have a longer term kind of better social distancing in the office, but it's probably not going to be overly material, but it could surprise to the upside. Yeah, I think it's very likely that remote work will continue increasing probably through the winter until there's a widely available vaccine. If we want to be optimistic, perhaps that will be in the spring of 2021 or early summer of 2021. But really, there is a long winter ahead, and really a long 2 or 3 or 4 quarters ahead for office space. I don't think investors should be, as a base case view, assuming that there's going to be a significant return to the office until there's a vaccine or until something changes with how COVID-19 is playing out. So far, it's actually been a little more resilient than I would have expected. If we look at the headline numbers, asking rents are only down by maybe 1 or 2% compared to pre-COVID levels, and occupancy is still relatively strong. Our view is that that will change over the next 6 to 12 months. There's been perhaps a number of companies that have been delaying making a longer term decision and just looking for shorter extensions. So we do expect some softness in the office sector, but really so far, if we just look at the actual observable data, it's been performing pretty well as of late September. Every recession has really been different, and this is certainly no exception. Uh, if we look at sort of typical measures of perhaps GDP or the unemployment rate and try to translate that into real estate performance, it doesn't really work very well because this recession is so different than has occurred in the past. Government stimulus is much more significant than it's been in the past, which is a positive. GDP declines and employment declines are much worse than they've been in the past, which is a negative. So it really requires a lot of sort of individual kind of first principles analysis that varies by property type, it varies by market, and comparisons to prior recessions, I think, are fairly limited in value.